You're trying to learn how to scalp. You're reading every book in the arsenal, but I'm telling you, what you need to do is grab a notebook, listen to these 7 tips, and I guarantee they're going to change the way you scalp. Let's get to work. Now, look, I've been exactly where you are. And I know what you're thinking. I have every indicator on my chart. I have the MACD, the RSI. I have my clear trend that we're in, some lines going down, everything in between. But what I'm going to tell you, rule number 1, is less is more. Get out of this ASAP. We're going to go in and we are going to delete all of it. That is number 1. We need to make sure our chart is crystal clear so we can move into step number 2, which is going to change and revolutionize the way that you look at your charts. Because if it's not clean, if it's not cut, if it's not clear to where you're getting in, to where you're getting out, then do you really have a strategy, or do you have something that you are assuming is the right direction? After we've cleaned our chart up, now it's time to move into step number 2, or tip number 2, supply and demand. What supply and demand tells us is where we've been and where we're going based on buyers and sellers. So we have our demand down here, and then we have our supply level all the way up here. Now, again, if you're not familiar with supply and demand, we have educational videos breaking this down so you can learn along the way as well. So make sure you're checking those out. The links will be down below. But what we're looking at now is we understand the channel in which we're trading, or the overall trend. And you can see that we are now respecting and moving down in a clear trend back towards that demand level down here, clearly working in a clear function. And it's the simplest and easiest way to trade. And what do we always say, and what do you hear all the time? The trend is your friend. Supply and demand will guide you 100% of the time, and very rarely will lead you astray. And before we move on from this subject, a quick little tip here as well. It's from a top-down approach. So you want to start at something like the daily, then the 4-hour, then the 2-hour. I don't love to use supply and demand on the 15 and under. They're just less reliable. The 1 hour and above is generally the best rule of thumb to find these levels, to understand what's happening here. But again, the links are down below to get more education on these. I don't want to spend 20 minutes going over one specific area. Now, we've eliminated the clutter. We've gotten to the supply and demand, the foundation of how we trade. But now we want to add 2 indicators that will help you find some of these entries along the way to really improve the supply and demand aspect. The only ones that we're going to add are going to be the EMA, and that's going to be the 9 specifically. We've gone and had plenty of videos over this, and then VWAP. That is it. Now, everyone always asks me about VWAP. Which one is it always different? Is it this or is it that? VWAP is a constant. There's no reason for you to be switching, going into settings. I just eliminate all the bands. All you need is the actual VWAP. That is it. What these do, and just so you know, I prefer to use these on about the 5-minute time frame. That gives me the best visual, because that's where I do a lot of my scalping, is between the 1 and 15 minute, getting in and out of those trades, right? Now, we find our levels on higher time frames to get the best reaction times, and then we use tools like the EMA and VWAP to give us more significant entries and signs of weakness along the way. And I also want to add in, I had to delete that upper band right there, but I want to add in that there are video links down below also breaking down the 9 EMA and the VWAP, so giving you a better understanding really quick as well. We'll have more coming on the channel, but letting you know specifically about this. Next up, we have our long-term indicators, and these are just going to give you a broad spectrum and a look at what's happening with the market as a whole. Because what did we say in the beginning? The trend is our friend. So we want to identify where we're moving and key levels that we are above, because we need to understand key levels and then supply and demand in between there. So the big long-term indicators that I use only are on the moving average. So basic moving average. And if it doesn't show up as moving average on whatever you're using, the simple moving average is the same thing, but the SMA on TradingView gives you a different viewpoint. Now, the ones I use specifically, okay, this is the ones you should be using for me alone. And I keep these mounted on the daily chart. So I would use the 50, the 100, and the 200. The 200 being the most respected, and this is the one you see me use on the channel every single day. But I'm not done yet. I'm gonna go to the time frame and I'm gonna mount these to the daily so I never get confused. You can even come in here and change this to a different color if you want, and that's what I do here. All this is gonna tell me is where we're at on this trend. For instance, when we look at the daily chart looking at SPY, you can see when we are below this, we're clearly bearish on the daily 200 SMA. But when we're above it, we're clearly in a bull trend. Now, when you get very close to this level, you need to identify and you need to understand it, because it's going to give you a better look and maybe get a reaction from this level also that we might not see in our supply and demand. Now, there's a high possibility that you're going to have levels around this, but it's always better to be safe than it is to be sorry. Now, number 5. Now, if you're watching this video, I don't know what you trade. You could trade equities, you could trade Forex, you could trade whatever. Now, we look over here at our stocks. These are our equities, some of the ones we're looking at, but I don't focus on these first. Let's say I love trading Apple and Tesla. I'm not going to jump right into those charts. What I'm going to do is go into the Nasdaq and the ES. These are futures, and they're basically going Sunday evening through Friday's close, basically 24/5. So they're operating even in the after hours nonstop. They don't stop like SPY does, even, because that's an ETF. Now, when you look at the Nasdaq, these are going to give you the best directional moves on the market. When you watch our previous videos and you see what we were talking about, our key target being that 12.9 region here on Nasdaq, there's a reason why we almost got straight to the top of almost 13K here on the Nasdaq and then rejected, right? We came right into our target. So if we have targets on futures and we hit those levels and then we start to revert back towards the downside, this is a key sign that we should be trading the market in favor of the futures, right? I don't expect to trade tech to the upside if the futures are coming down. So ever since basically February 2nd, take a quick look at what's happened with something like even Apple, which is a primary source in the ES. You found your top near February 3rd, and ever since then, you've been pushing down. These are things you need to be identifying, because the futures are going to lead your equities. So the futures have got to be the foundation of where you're spending a majority of your time, and then finding equities that line better up with this as far as weakness and strength. Now, if there was ever a part of this video that would be my favorite part, it would be right now. Risk to reward. And I believe TradingView gives you like one of the best outlooks on looking at this, because it's so easy to do. Now, if I want to trade something, I'm going to give you an example of something like Nvidia. And if I look at Nvidia and I look at this trade, over the past few days, I've been loving semiconductors, and I've been wanting to trade downside specifically here. And if I come in, I can go over here to a longer short position, and this will just give you a layman's term view of this, right? And what I'm going to do, and you can actually star this to make it a little bit easier for yourself. Now, if I come into Nvidia and I'm looking at trading this towards the downside, so we're going to actually delete that. We're going to go to about a 15-minute time frame, go to full screen. And as we look here, what's going on? So what we'd be looking for, and I've been saying, is we really want to get below 227. That's the goal here. But even if right now, let's say hypothetically I wanted to take this trade and force a trade, right? Rule number 1, forcing trades, very bad. We don't want to have that. You go over here, we're going to get our trend line, we're going to come back in here, and as we do this, we're going to say, okay, we're going to force a trade, and we're going to play the downside just to 227. Now, if I wanted to take this, and let's say my stops were at, the local highs here at 234, a risk reward tells me this. If I get in right at this point right here, my stops are right above this swing high right here, and then my target is down at near the 227, let's say 228 to be conservative. Risk reward gives me a defined look at what I am risking right here. It's a 2.33. So it's dividing what my risk is to where my stop is to my reward opportunity. So what I can see here is for every dollar that I'm risking, I'm looking to make $2.30. That's just from a stock point of view. When you go into options, this gets a little bit more technical, but this gives you the best view of overall what you're risking in a trade. Sometimes we go into trades where our risk is equivalent to a 1, and this is a trade that just isn't in our favor. In fact, you'd rather go play blackjack because you probably have a higher % chance at winning than taking a trade like this, because your stop and your reward do not put you in a position to consistently win. You want to have a strategy that allows you to lose, which sounds crazy, but if my average trade is at about a 3 risk to reward ratio, then I can officially lose 2 2 out of 3 trades and still pull profit based on math, okay? So you can come to this standpoint and still really define your strategy and look for what you're trying to do, whether it be, swings or even scalps, which is what we're talking about in this case. But when it comes to scalps, I really encourage you to really zoom in, and you're going to want to be more technical with what you're doing here, and definitely be more deliberate with watching your risk to reward levels here. Now, this is the last one, number 7, fundamentals versus technicals. And when we go into this, you have to understand that you can maybe make some fundamental scalps, but you need to identify that it usually takes longer for fundamentals to really play out. When we look at the market, I just marked some of these levels that have happened over the past few days. We had bad CPI data, bad PPI data, then bad PCE data. Now, from this, we've been pretty much bearish since we started getting this bad data pool. But look how long it took to play out here. This was not a scalping opportunity. And if you were scalping, you needed to get out of your positions because you were bouncing back and forth. But if you were swinging, then you've been consistently making profits holding that position, sitting, comfortably in the green, because you continue, as you can see here, to make lower highs, right? We can just continue to see the trend that's forming here. It's just over and over and over. And this is structurally very bearish. But you have to understand the difference and be okay with what you're doing here. When I'm going into a swing, I understand that there's a pretty high possibility that my trade's gonna go into the red and probably the beginning stages of it, right? I expect that, but I'm comfortable with my position overall. Now, this video is focused primarily on scalping, but I want people to identify and understand that when you're looking at a fundamental viewpoint, it's not a good idea to take fundamentals and try to pair them with scalping, because again, the market tends to move in waves, and you're not just gonna see a straight shot down continuously based on fundamentals typically.